Did you know that a single crypto transaction could trigger a taxable event that costs you thousands? Even something as simple as buying coffee with Bitcoin or swapping one cryptocurrency for another creates a tax liability that most people completely miss. The IRS has been ramping up crypto enforcement, and they're catching more investors off guard every year. In fact, the agency has already sent over 10,000 warning letters to crypto holders who may have underreported their taxes. Today, I'm going to reveal the 5 most dangerous crypto tax traps that could be silently draining your wealth, and more importantly, how to avoid them completely. Let's start with the biggest misconception that's costing people the most money. Many crypto investors think they only owe taxes when they cash out to dollars. This couldn't be further from the truth. Every single time you trade one cryptocurrency for another, you're creating what the IRS calls a taxable event. So if you bought Bitcoin at $30,000 and later traded it for Ethereum when Bitcoin was worth $40,000, you owe capital gains tax on that $10,000 profit, even though you never touched a dollar. This crypto-to-crypto trading rule catches thousands of investors completely off guard. The second trap is even more subtle and affects anyone involved in DeFi or decentralized finance. When you provide liquidity to platforms like Uniswap or PancakeSwap, you're not just earning rewards, you're potentially creating multiple taxable events. Every time the protocol automatically rebalances your liquidity position, it's treated as a separate trade for tax purposes. Some liquidity providers discover they owe taxes on hundreds of microtransactions they never even realized were happening. The third trap involves staking rewards and mining income. Many people assume these are tax-free until they sell, but the IRS treats staking rewards and mining payouts as ordinary income at the moment you receive them. So if you earned $5,000 worth of staking rewards throughout the year, that's $5,000 of taxable income, regardless of whether you sold those tokens or not. This can create a cash flow nightmare where you owe taxes on assets you're still holding. The fourth major trap is the wash-sale rule confusion. While traditional wash-sale rules don't technically apply to crypto yet, many investors are using this loophole incorrectly. They'll sell Bitcoin at a loss and immediately buy it back, thinking they can harvest the tax loss without any consequences. But if crypto wash-sale rules are implemented retroactively, which some tax experts believe could happen, these transactions could be disallowed, leading to massive penalties and back taxes. The fifth and perhaps most dangerous trap is inadequate record keeping. The IRS requires detailed records of every crypto transaction, including the date, amount, fair market value in USD, and the purpose of each transaction. Most crypto exchanges only keep records for a limited time, and some have even shut down, taking transaction histories with them. Without proper documentation, you could face penalties of up to 40% of the unpaid tax, plus interest. Here's what makes this even more critical. The IRS is getting much better at tracking crypto transactions. They've invested heavily in blockchain analysis tools and are working with exchanges to match up user transactions with tax returns. They can now trace transactions across multiple wallets and exchanges, making it nearly impossible to hide crypto activity. So how do you protect yourself from these traps? First, treat every crypto transaction as a potential taxable event and keep meticulous records. Use crypto tax software like CoinTracker, Coinly, or TaxBit to automatically track your transactions and calculate your tax liability. These tools can connect to your exchanges and wallets to import transaction data automatically. Second, understand the difference between short-term and long-term capital gains. If you hold crypto for more than 1 year before selling or trading, you'll qualify for long-term capital gains rates, which are significantly lower than short-term rates. This simple strategy can save you thousands of dollars in taxes. Third, consider tax loss harvesting strategically. While you can't use wash-sale rules to your advantage indefinitely, you can still harvest losses by selling underperforming crypto assets and using those losses to offset gains from your winners. Just be careful not to repurchase the same asset within 30 days if wash sale rules are eventually applied to crypto. Fourth, if you're involved in DeFi, staking, or mining, set aside money for taxes throughout the year. Don't wait until tax season to figure out how much you owe. A good rule of thumb is to set aside 25 to 30% of any crypto income for taxes, depending on your tax bracket. Finally, consider working with a tax professional who specializes in cryptocurrency. The rules are complex and constantly evolving, and a specialist can help you navigate the gray areas while ensuring you remain compliant. The crypto tax landscape is only going to get more complex as regulations evolve. The investors who take proactive steps to understand and plan for these tax implications will be the ones who keep more of their profits. Don't let poor tax planning destroy your crypto gains. If you found this information valuable, make sure to like this video and subscribe for more crypto and personal finance content. And in the comments below, let me know which of these tax traps surprised you the most. Have you been making any of these mistakes with your crypto taxes?